welcome to our latest Stanford Brown SB Talks podcast. Today is Tuesday, the 10th of May, and I am today joined by Stanford Brown Investment Committee member and former RBA Governor Ian Macfarlane. Welcome, Ian.
Thank you very much.
Now, today our plan is to first and foremost get some insights from Ian from his many decades as an economist and also as an investment manager, to find out a little bit about his background that led him to his 10 years in the role as Governor of the Reserve Bank, and then to glean some insights from you with regard to the current outlook in terms of monetary policy, inflation, and broader economies, because it has been quite an interesting time over the last 10 days, in particular with the RBA making its move, first interest rate increase since I think November 2010, and we're back in a raising rate environment. But to start us off, do you mind sharing with us a little bit of your backstory? Obviously you woke up as a young boy one day and decided, I want to be the Governor of the Reserve Bank, so how did that path unfold?
I was born in Sydney, but family moved to Melbourne when I was 3, so I was brought up and educated in Melbourne. Went to Monash University, and I know there's a little story you want me to tell here.
No.
Yeah, I know you are. You've asked me before, and I graduated with an honours degree in economics. And like most people of that era who were interested in economics, they thought in terms of a job either at the Reserve Bank or Treasury. So I applied for a job at the Reserve Bank.
This was
first job I applied for.
Out of university?
Yes. And I was rejected. And I was not just slightly rejected, I was totally rejected. Right. I didn't even make it to the interview.
Right. Rejected at the first cut?
Yes. And the reason was that they had a thing called an attitude test. Right. It's attitude, that's double T.
Attitude, not aptitude.
Yes, attitude. And they concluded that I had a bad attitude.
Right.
And as a result, they weren't interested. And so I was very disappointed. You're always disappointed if you get rejected. But looking back, like a lot of the rejections, it turned out for the best.
The best thing that could have happened.
I was too early for me to just go straight into a job like that. And so instead of doing that, I ended up...
What path did you take?
Well, I ended up scurrying back to the safety of the university.
Right.
And took a tutor's job there and did a master's degree. Then I went overseas and I worked at Oxford University for a while, and then I worked at the OECD in Paris.
What was your role there?
First of all, I was coordinating the forecasts for a few years, and then I was put on the Canadian desk, and I was responsible for Canada for a couple of years, and then I was responsible for Australia, New Zealand and Ireland.
Right.
And then that's when I came back to Australia. And when I came back to Australia, looking for a job, it was a very tough period to get a job.
So what year was that?
1979.
Okay, yeah.
And in the end, the only institution or business in Australia that offered me a job was the Reserve Bank.
Right.
So I ended up back at the Reserve Bank 11 years after my initial rejection. Unfortunately, by then I was too senior to have to sit the attitude test.
Right. Or perhaps the attitude test had evolved somewhat over the years.
No, it was still there. It was still there, and we didn't get rid of it for a few more years. Right. I wasn't the only one who wanted to get rid of it. A lot of other people wanted to get rid of it, and we did.
So what role did you take at the RBA when you first came back?
I went to the economics department, not surprisingly, and went through several roles there, and then I moved to the financial markets department, which is where you deal in the money market, the bond market, and the foreign exchange market. Then back to the economics department, and then I headed the economics department, which means you're really effectively the chief economic advisor to the Reserve Bank. Then I became deputy governor, appointed by the Keating government, and then I became governor appointed by the Howard government.
1996.
That's right.
Do you mind sharing with us a little bit of the sort of economic backdrop at that time as you came into the role?
Well, we were still on the long path to recovery, in a sense, from what went wrong in the 70s. I mean, the 70s was a big shock to everyone, particularly in the economics profession, where we had simultaneously a recession in the middle of it, and right at the end another one, and a long period of high inflation. In fact, it was the world's only long peacetime inflation. All the previous examples of inflation have been associated with war and war financing.
War, money printing.
Yeah, and the 70s was a shock, and we were still in the 80s and the 90s, I think, preoccupied with the need to get inflation down, because history told us not just inflation, low inflation was a good thing, but if you wanted to have a long, durable expansion, it had to be a low inflation expansion. All the good expansions were periods of low inflation. The periods of high inflation were very disturbed periods, and usually periods with poor economic growth and often high unemployment. So that was the overriding...
Yeah, certainly by the early 90s, rates were still high. There was still very much an eye on bringing the inflation rate down.
Yeah.
What, do you mind me asking, what was approximately the Reserve Bank rate at the time that you were coming into the role?
Oh, by the time I came in to become governor, most of this had been accomplished. Yeah. Inflation had really sort of returned to a low rate by about 92, and interest rates, the Reserve Bank overnight cash rate, I can't remember exactly what it was, but it was down to 5 or 6, from having been as high as 18.
So there's the normalisation of rates in the opposite direction.
That's right, yes, we had to normalise them on the way down, and at the moment we're in the process of
normalising
on the way up.
Normalising on the way up from 0 back to a 5 or a 6 would be quite a climb. Now, in your time in the role, it certainly wasn't a straightforward period. You very quickly ran into the Asian financial crisis, like Russian default in the early first couple of years in the role.
The Asian financial crisis was from the middle of 97 through to probably the end of 98. And Australia acquitted itself extremely well during that episode. Even though...
And your governorship would be very well regarded for how it handled that period.
Yeah, well, I was mainly notable for doing nothing.
And the highly undervalued strategy of doing nothing.
Yes, indeed. Sometimes the hardest thing to do is to do nothing or to say no. We got through that very well, even though Australia, of all the developed countries, OECD countries, had the biggest dependence on Asia in terms of the share of our exports that went to Asia. And so in some sense we were thought to be the most vulnerable, but we got through extremely well. And our reputation internationally, particularly in Asia, rose during that period.
For the stability that was able to be achieved through it. And of course you had, not long after that, there was the world recession.
Yeah, that's one that people have forgotten, but there was a recession in 2001 that followed the dot-com boom and was referred to as the tech wreck.
Yeah.
And it wasn't just because the share prices fell, it was because there was a collapse in investment, business investment that had been associated with the dot-com boom, and suddenly all turned off. And so, and it wasn't just, and telecommunications was a big part of that story too. And we sailed through that.
Australia being less of a tech hub, obviously more of a traditional, or perceived traditional.
Yeah, well, in fact, we suffered during that period because Australia was perceived as an old economy. That was the term, old economy. So we didn't get the uplift during the dot-com boom, but we didn't get the crash either. But that was a period where the Australian dollar actually went down to 47 US cents. Purely, I think, at the time, because of that perception that we were an old economy. Because the Australian economy itself was performing very well.
Would you have any key learnings or takeaways from your time in the role? Any sort of key reflections?
Well, you keep learning. 50 years as an economist, you learn a lot each year. But there are also reflections where you look back over the whole period and ask yourself, how did things change? Or what did you learn during that period? And I think there definitely are some things that have changed quite a lot. The first is that when I first entered the profession, we expected to become really good forecasters. And we spent a huge amount of money building econometric models and all the rest.
Leveraging technology to perfect forecasting.
Well, we didn't perfect it at all, and in fact, my view now is that we are no better at forecasting than we were in 1970 when I started.
Why do you think that is?
Well, just the nature of the world. We were kidding ourselves that we thought we were going to be able to, like engineers, build a little machine that would forecast the future. You can't do that. What you do now, really, is you look at the economy and say, how can we make it flexible and resilient so when the unexpected happens, it doesn't break, it bends. And there are various things you can do, and we have done. Like, for example, you have a floating exchange rate rather than a fixed exchange rate. You make sure the banking system is extremely well capitalised. And there are a whole lot of other things you can do that make the economy more able to handle,
more resilient,
the shocks that you failed to forecast. The second thing I think that I learnt is over the length of that period was that the financial sector is now much, much bigger and more important than it used to be, and is actually the source of most of the recent shocks. Instead of being the shock absorber, it's been the source or the cause. Obviously the GFC was a classic example, but there were 3 or 4 before then as well. And that's very different from when I first started. And the final thing I think I learned is that we spend a lot of time looking at monthly, quarterly statistics, even daily statistics, but the really big things that influence an economy evolve very slowly, and they evolve so slowly that you know they're there, but you can't really have difficulty taking them into account because they don't change quickly. The two things I'm referring to here, which I think have dominated economic development over the last 40 years, have been firstly globalisation, and secondly labour-saving technology. And they've had a huge influence on the economy, particularly the distribution of income.
Productivity and distribution of income.
Yeah, yeah.
Would you have any fears that that long-term macro trend in globalisation may now be reversing somewhat with protectionist policy and obviously the effects of COVID on supply lines?
Yeah, I think the latter is important. I think it got pretty well as far as it could go, and I think the events in Ukraine and some of the behaviour of China have made countries aware of just how precarious the supply chains are, and I think we can see a reversal of globalisation there. One of the obvious one is if Europe stops importing Russian energy.
Awesome. Well, and I guess, I think countries very much realised that essential medical supplies and things like that, those need to build capacity onshore to manage that. Let's actually take that broader theme and move it forward then. We're talking about long-term trends. The big clear trend post-GFC has been the new normal monetary policy. We've had interest rates at essentially zero for a very long period of time, with extremely accommodative quantitative easing and other things at play. What is your overall feel on, I guess, the approach to monetary policy over the last 10 years, since 2012, 2013, and the Mario Draghi do whatever it takes approach?
Well, I actually think it was a very clever thing by him, but I think over that period I'm uneasy. I think the central banking community, egged on by the economists, have undertaken an experiment, and put in place the easiest monetary policy in recorded history, which could be summarised as really a decade of zero interest rates, plus in the US case, 4 examples of quantitative easing, which, by the way, is a word that was invented in 2010. We didn't do it before, and we didn't have a word for it. The bit that worries me is that even though it was the most extreme response to monetary policy, the barrier or the obstacle that he was trying to overcome was not all that extreme. I mean, it was instituted really from about 2010 onwards. This is quantitative easing.
Yeah.
It's not as though they were facing the Great Depression. In fact,
yeah.
can we continue? And there wasn't even a recession during that period. The US economy grew at 2.2% per annum from 2010 to 2019. So it seemed to me that the remedy was out of all proportion to the size of the problem.
What do you think drove that? Was it, I don't want to say populism, but a fixation on financial markets and the need to...
No, I think it was...
What was the motivator?
I think it was a too mechanical interpretation of inflation targeting.
Right.
During that period, inflation was below the band that central banks wanted, but not by much. I mean, I think it averaged about 1.6 or something. And I just think that people felt that monetary policy was much more powerful than it really was. And it kept pushing it to an extreme to try and achieve this outcome.
Do you think they possibly became complacent that they could do what they wanted and not have to have inflationary outcomes, having pushed for so long and not seen inflation significantly move?
Yeah, you're right. By the end, by the time you'd had 3 or 4 years of inflation of 1 point something under your belt, I think there was a feeling that, and whilst you were trying to push it up, and it refused to go up, I think they did really think that, well, we've entered a new world and inflation it's only a problem insofar as it's too low. And they took their eye off the possibility that it could rise. And I'll say more about that later when we get on to talking about inflation. But now I'm not really, I don't think history will judge that period of monetary policy favourably.
Do you think that the current central bankers have adequately or are coming to terms now with how far they went?
Well,
there's probably 2 different categories there. One, to look at the Fed, who's sort of been slightly quicker to move than the RBA in terms of starting some form of bringing monetary policy back in line.
Well, they're in the process of raising interest rates everywhere now.
In the US, they're working very, very hard to manage market expectations ahead of what they do.
Well, the interesting thing in the US is that this isn't the first time that they have tried to normalise interest rates up.
2018.
Between the end of 2015 and the end of 2018, the Fed set out to normalise interest rates. It raised the Fed funds rate 9 times. So it rose from 0.1% to 2.4%. They stopped QE. In fact, they reversed it and started selling bonds. And they were heading back towards normality, I thought, pretty successfully. I was certainly sort of cheering on the sidelines. But the amazing thing is they hit an obstacle in the middle of 2019. This hasn't been widely reported, but the obstacle they hit was that significant parts of the US money market froze. The repo market froze. I mean, there's a lot of parts of the financial market that depend on, are highly leveraged and depend on being able to roll over short-term borrowings, including overnight borrowings, weekly borrowings, fortnightly borrowing. And if they can't roll it over for some reason, if the lenders are reluctant to continue to lend it on the same terms, they have to dump assets, and that's what happened. And in the end, the Fed.
You're talking about late 2018 here?
No, this is middle 2019.
Right.
Middle 2000. They stopped raising rates in 2018.
Because
as
December
you said.
2018, the
was the last
financial
one.
markets had sold off. The
Yeah.
US in particular sold off about 20% of that stuff, and then they...
Yeah, but it wasn't the reaction to the share market falling off, although I'm sure they did have an influence. But the crucial bit was the short-term money market froze up. And that's frightening, really, to think that you only got that far and the thing froze up. And that's what worries me a little bit about the future.
Of what we're doing right now.
Well, it may happen again before we get interest rates back to where they should be. And that's what happened that time. That may happen again.
Let's talk inflation. You talked about the 70s and the sort of only sort of peacetime hyperinflation market, if you want, period.
It wasn't really hyperinflation. Not allowed to use that word.
Okay.
It's
Yeah,
got to be about 1,000%.
1,000%, okay. I take your better knowledge of mine on that one. Let's call it inflation well beyond the norm of what we're accustomed to. Would you have any fears that we might be at risk of heading toward that type of an environment?
No, I don't think so. I don't think so. I think there were very special things that underpinned that high inflation of the 70s. Particularly in Australia, for example, we had centralised wage fixing. In fact, it was quarterly centralised wage fixing. So each quarter, this body called the Arbitration Commission, where a group of judges would look and see what had happened to the CPI the previous quarter, and then make a decision how much of that should be passed through into wages. It was usually 100%, not always. I mean, that's extraordinary.
So that was a self-perpetuating sort of loop.
Yes, and I think in the US they didn't have anything quite as extreme as that, but a lot of the wage bargains had cost of living clauses in, which had much the same effect. We had quite high protection in tariffs and quotas, and so we didn't have that anywhere near the degree of international competition that we have now. So I can't see a rerun of the 70s. I don't think that it's possible, but I think it's unlikely.
Yeah. And do you expect, I guess, there's been this whole debate around what's transitory or non-transitory inflation in the post-COVID area, supply shocks and all these types of things. Do you have a view in terms of current levels of inflation and where they level out at?
Well, everyone, I think, who tries to forecast inflation, now having said rude things about forecasting, I have to concede that you have to do it.
Yes.
And if you're modest, you say, this is my assumption about the future. And I think you have to make assumptions. I think everyone who does it correctly has a profile for inflation which rose sharply and then it's going to come down, because it is true that a significant part of inflation is transitory. It's due to supply shocks. And you've got to remember that for example, energy prices or food prices don't have to go back down to where they were for inflation to stop. They simply have to stop rising.
Stop rising at the same
At
pace.
a high level.
Yeah.
They reach a high level and just stop rising at that high level, so, which I think will happen. And so I think it's correct to assume that inflation some of it will go down. And the question mark is, once the transitory part has worked its way out, what are we going to be left with? And I think there is enough of the inflation is more than transitory that we're going to be left with probably an inflation rate that's nothing like the inflation rate we went into this with. It's not going to be 2%, I think. I don't know what it's going to be, 3 or 4%.
Okay.
I mean, one of the things you've got to remember is that workforces around the world have just received a reduction in their real income because prices have risen much faster than wages. Now they're going to want to try and recover that. And you've also got to recognise that unemployment is very low around the world. That's one of the big surprises. The US, it's 3.6%. I mean, that's boom time unemployment rate.
So you I guess you're painting a picture there where there's going to be wage pressures which then could feed back into the inflationary pressures.
Yeah, it will limit the fall in inflation. And so this is interesting. What's the implications of this for interest rates? Well, let's look at the short run first.
As of the day that we're talking, last week the RBA made its first move because first increase since November 2010. 25 basis points increase.
But the interesting thing is that the market has fully accepted that short-term interest rates are going to go up. And in fact, I think they've actually overestimated how quickly they'll go up in the short term. But at the moment, the yield curve says the market is expecting the overnight cash rate by the end of this year to be 2.92%. Now, in order to get that, the Reserve Bank would have to move every meeting between now and December, and on two of those meetings, at least two of the meetings, move by 50 basis points. Now, I can't see them doing that, and I actually don't think they need to do that. I think that you don't have to play catch up that quickly. So I think the markets overestimate how quickly they're going to go up. But on the other hand, I think if you look over the medium term, I think the market's probably underestimated how far they will have to go. These numbers change every day, but I mean, I think the US and Australia, they're sort of almost assuming that if they go up to 3, that'll be enough. That'll be the terminal rate. And I don't think that's going to work out that way. I mean, if inflation, once it's got over the hump, goes back to 3 or 4, you're going to need more in short-term interest rates to maintain anti-inflationary pressure. A 3 won't be enough.
It's not touching the brake nearly hard enough.
Well, it may well even be still a negative real rate. So I think in if you take a 3 or 4 year horizon, I think the market's underestimating how far we'll probably have to, if we can. Now, there is a possibility that we can't. There is a possibility that the financial system has become so highly leveraged.
It's so fragile and risk of further shocks.
Yeah, that
the tail wags the dog.
That what we get is a repeat of what we had between 2015 and 2019. So, particularly in the US, I don't think that's a risk here. We've got a different risk here. The risk in the US is always the ingenuity of financial markets in coming up with new products, new ways of leveraging things so you can increase the rate of return. And that's a risk in the US, as it was in the middle of 2019. It's hard to believe that that risk has gone away completely. And that may cause, as it did then, the Fed to stop at an interest rate which is actually not inducing much downward pressure on inflation. And so inflation will stay roughly at where it got to, and if it got to 3 or 4 or something.
So take that a slight step further, and you're right, certainly the US financial system, I guess, is that much more sophisticated with derivatives and other types of products there that make it more fragile. In Australia, where do you feel that the rates might get to? And I appreciate we're barely at the first step of a rate increasing cycle here, but if you had to put a best estimate today of where you think they need to get to bring things back into equilibrium.
The US is really going to determine the outcome for the world.
If the US falls over, then we all react.
I think so. If the US calls off the increase, then I don't think individual countries will be able to push ahead because of the effects on their exchange rates. So I think the whole thing really does depend on the future of US monetary policy. Now, in Australia, if you have a long period of easy money, where does that show its effects? Housing and mortgages. In the US, it's Wall Street. In Australia, it tends to be housing and mortgages. And so it would be the pressure point.
Would you have concerns for the Australian housing market?
I think it'll fall, But then that's not a big deal.
Mm.
It has fallen on several occasions I can remember by 5 or 10%, and it may well fall by more than that. And that's not a tragedy. Probably in many ways it's actually a good thing for most people, other than those people who have most recently taken out a very large mortgage and are highly leveraged. And that, of course, is a small proportion of the population, but they will be the ones who would feel the pinch first. And historically what happens, and this has happened before too, what happens is, by and large, they continue to service their mortgages and they cut back on other things. They've got some buffers there as well. They've got a lot of people are ahead in their mortgage repayment schedule. They've got a lot of money in offset accounts.
Maintained the repayments amount for many years.
Yeah.
At a higher rate.
Yeah. Though there are some little problems lurking. There are a lot of people who took out fixed rate mortgages, which are going to, at the end of the 3-year term, fixed rate term is going to jump. That was a big problem in the US back in the GFC that happened. But
albeit their mortgage structure is somewhat different. They sort of more than 30-year mortgage terms.
Yeah, they were much worse. They're much more extreme than what we had. But I think
because the point that you're making, well, there is sort of saying, okay, well, the housing market's probably got a fair bit of buffer built into it, but the flow-through impact is sort of to the mainstream economy. If yes, people batten down the hatches, and typically at all else you preserve your mortgage payments, but at the cost of what else? Would you have concerns for how well Main Street Australia withstands the normalisation?
Well, I think that would certainly cause consumption to be lower than it would otherwise be, and that will be a contractionary effect on the economy. I think at the moment that doesn't immediately spell the word recession. It does suggest a slowdown. We're on the right side of history at the moment in that we produce goods that are in demand and short supply. Our terms of trade are in very good shape. We don't have, I don't think we do have many highly leveraged businesses. We might have some startups that are like that, but the mainstream Australian business is not like that. So I think we're in better shape, for example, than the US. Probably as good a shape as any of the developed countries.
Yeah. The lucky country continues on. Any other key items or reflections, I guess, around where you foresee monetary policy over the next decade even?
No, I don't think I can. I could not have foreseen that we would go through this zero interest rate experiment, nor would I have foreseen QE. One of the things I think we will see, though, is the recognition that you can't solve all the problems with monetary policy. And that was part of the problem during that previous decade, is all the pressure was put on monetary policy. And the central banks themselves, I think, believed, oh, we're the saviours, we can fix the system.
Felt the responsibility was on them to come up with the
I think they were overconfident too. I think Bernanke in particular was grossly overconfident that he would fix things. And I think we're going to see much more modesty from central banks going forward. I mean, the fact is, inflation is not simply caused by monetary policy. Sure, monetary policy has a big influence, and sometimes the crucial influence. But there are plenty of other things also have an influence on inflation. And sometimes these other things are bigger than what the central banks can do. And so those two great big influences I mentioned at the beginning, globalisation and labour-saving technology, they've had a profound downward effect on inflation. And I think that's how inflation got to be so low. And central banks fought against it, but they weren't powerful enough. Those forces were bigger than what central banks could do.
But we potentially see some of those trends starting to reverse. So,
well, I don't think they'll reverse that much, but there is. Yeah, well, I think
modest.
I think the globalisation, the trend towards globalisation is nearly run. It's either run out of steam or there will be slight reversal.
Yeah, there's limited scope for it to go any
Yeah, but the technology is still charging ahead, finding ever more ways of producing things without human intervention.
And just to finish us off, I might take us back to that attitude test. So just what did you write in that test that such that...
Well, I think the test, the Reserve Bank had been part of the Commonwealth Bank. Well,
Yes.
the Commonwealth Bank being part of the Reserve Bank. And I think the Commonwealth Bank had a great need for tellers because they had a huge branch network.
Right.
And the test was designed to find people who would make good tellers. And so the questions, they would give you two alternatives. One would be quite an adventurous thing to do, and
Right.
the other thing would be a really cautious thing to do.
Right.
And I made the mistake of choosing the adventurous things and not the cautious things.
Right.
But because that's what they're looking for. They're looking for people who were risk averse, cautious and obedient. And I didn't fit into that category.
Oh, well, probably, as you said, it was all for the best and brought you through. I guess first and foremost, I just want to congratulate you on, I guess, obviously your stellar career and very much thank you for your ongoing contribution to Stanford Brown Investment Committee. We certainly are in a very interesting period for not just monetary policy, but for markets as a whole. And I think we can probably expect to hear more and discuss more as the situation continues to evolve, as we're very early in that rate rising cycle. But thank you very much for your time this morning. Ian, it's greatly appreciated.
Well, thank you for inviting me to participate with Stanford Brown. I've enjoyed it so far, and I found it very interesting.
Excellent. Thank you.